No background music. How about this? Do 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 do. All right. We are counting down. I'm just experimenting here with this countdown timer. So we can turn that off. We can take the timer. We can put it right there. So if you want to hey, hold on a sec. I have to get my water. It's way over here in the pool room. There we go. Oh yeah, we're live now. Look at that. We are live now. All right, I'll make better use of that at some time in the future. Thank you very much for showing up today. And as most of you know, after we complete the retrospective, I will edit it and put it up on the website so that you can access it anytime. You can always come back to the YouTube as well, but the edited version will cut out all the crap, like what we're doing right now, and just leave just the stuff. It'll be no fluff, just stuff. It's important to have fun with all of this, you know. All right, just gotta arrange the furniture here. All right, we know how to add a countdown timer. Thank you, sir. All right. Play the Jeopardy theme. Do 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 do. What I was playing was a Doobie Brothers theme before, if you didn't recognize that. All right, let's get started. So, this is the retrospective for last week. And the retrospective is part of our continuous improvement process where we do a retrospective or a look back at what we accomplished last week and pointing out anything significant and anything that was subpar, that was good, ideas that can improve upon what we do going forward. And so that's the whole purpose of the retrospective and the continuous improvement process, that we evaluate everything that we do before we go on to the next week and see that we can do something better. And, you know, there's not a guarantee that what you choose to do the following week is going to be better. But because it's an iterative process and because we time box it and bring it down to these small increments, what we call sprints. Now, if you're familiar with agile methodologies, that's sort of what this is all about. I happen to be a process expert. This is what I've been doing for most of my career, helping organizations improve their processes. Anyways, we break things down into small things. In our case, the biggest small chunk is a week. And then each week, we have 3 events. We have Monday, Wednesday, and Friday, 0 days to expiration events. After the end of each day, we go through a rather rigorous process of evaluating what we did during the day and at the end. And I try to summarize what happened. And then at the end of the week, we do sort of a summary of the summary. So that's what this is all about. And hopefully that works for you. I hope that this process is something that you will make your own as well. I think it's important. It's a little bit easier when you're doing it in a group context, I think, or at least watching in on what a group might do. All right, Lance is saying, going forward, would like an ES equivalent if you make an alert for SPX. I always try to do that. I try to create, I usually lead with the ES, quite frankly, as opposed to the SPX, and then create an SPX equivalent. But it's pretty simple to do. It's not something that is rocket science. But however, I am going to give you some guidelines here. It is really simple. All you need to know is what the price of the ES is and what the price of the SPX is at the same time, and then look at the difference. Right now, the difference is about 10 points. As we get closer and closer to the end of this contract, that difference usually starts dwindling a little bit, maybe gets down to 5 points at some point. But it's about 10 points. So all that means is that you then translate the strikes and just add 10 points, and wherever that leads you, that's the strike that you use for the SPX. Or if it's for the ES, then you subtract 10 points. But that's all there is to it. There is no other calculation or consideration between the SPX and the ES that you have to make. Now, if you go to the SPY, it's a whole different story. The SPY is about 1/10 of the SPX, and we don't really trade the SPY. If you're going to trade a micro, then you can trade the micro futures, for instance, which is MES as opposed to ES. And that should be the exact same strike as the ES. So that's all there is really to creating an equivalent, right? You got to be able to do that kind of work on your own. I mean, for me, that's just busy work and putting it out there because, quite frankly, you don't know how to do it or you're too lazy to do it. But once you know how to do it, then there's no reason to be lazy. All right, so now you know how to do it. All right, now in terms of position size and exit strategies, this is very important, and a lot of people asked about this last week. Position size, first of all, when I put out an alert, I usually put it out, or try to put it out, as the smallest possible size that you can put on for that particular trade or that position. So if it's a butterfly, it'll be a 1-2-1, and that's it. So a 2-size butterfly would be 2-4-2. Get it? Now, there was one case last week where I put out a 5-size position. Incoming chat. And probably never should have done that. And it was a mistake on my part. But let me just say that ultimately, position sizing is your responsibility. Let me say that again. Position sizing is your friggin' responsibility. It's not mine. I will take responsibility in some cases if I say that, from a relative point of view, this is the position size we should use. Your position size should be based on the size of your account. Now, the minimum position size, or the smallest possible size that you could create on any strategy that we put out there, for instance, with a butterfly would be 1-2-1. That should be good for accounts that are anywhere from a couple or a few $1,000s up to about, $7,500 or so. And you should never veer off more than a single position size for any of your trades. Now, that might differ a little bit from trade to trade, because what we're really trying to accomplish here is what's the risk inside of that position. And most of our positions have a risk of around, between $50 and $150. On edge cases may go up as high as $200, but that's very rare. Usually $50 to $150. Now on A $2,000 size, say a $3,000 account. What is a 5% size, right? A 5% size would be $150. You have to figure that on a $3,000 account, you probably never want to trade in any single trade more than 100 or risk any more than $150 or 5%. That seems reasonable. So that's how I come to this one size. Now on a larger account, say $7,500, now you're saying that, well, that same $150 is only only 2.5% of my account. I think that's fine for a $7,500 account as well. And you could probably take that 2.5% and go all the way up to $30,000 or $50,000. I don't think that you should ever trade more than 2.5% of your account all the way up to, say, $50,000. If you get to $100,000, I think you need to pare that 2.5% max position size down to maybe 1.5% or 1%. If you get up to $250,000, you probably pare that down to 1% or less. So by using that standard, you should be able to figure out how many contracts or how many positions that you can put on. All right? That's pretty much it. So smaller sizes, generally you have, as relative to the size of your account, the position size or the max risk is usually a little bit bigger, only because that's the smallest size that you could possibly put on anyways. So that's what you're stuck with. So because of that, with smaller accounts, there's going to be more volatility in your equity curve, because the relative size of winners and losers are going to be bigger for the smaller account relative to the max risk versus bigger accounts, right? So, you start out with a position size this big and account size this big. This is a lot, and plus or minus goes a lot. But then if you make the account size this big and the position size doesn't change, then it doesn't impact the account as much. It's the unfortunate truth is that when you have a smaller size, you're stuck with what you got. You can't make the size any smaller. So you have to endure for a time more volatility in your equity until you start catching the wind and getting ahead and making it bigger. Or if you can, you want to get up to that size that you feel a little bit more comfortable and have a better or a smoother equity curve. Maybe over time you add to your account, maybe get it up to $5,000, $6,000, $7,000 and start from there. But between $2,000 and let's say $7,500, you shouldn't really use more than one position. I use the term tranche as a synonym for position, right? And so a lot of times you'll see I talk about tranches. So let's say that you have something over a $7,500 account, a $10,000 or a $15,000 or a $20,000 account, and you allow yourself 2 to 3 positions. Does that mean that when the alert comes out and you're considering the trade and you want to put it on, that you immediately go to your full-size position? No, it does not mean that. As a matter of fact, it anti-means that. You should start out with the minimum position size and then give it some time to see whether or not you can get in at a better position to bring your cost basis down, to average down. So in other words, you get in and then the price pulls back even more. Now this happens to me all the time. When I put out an alert, most of you take that alert right then and there. A lot of you, well, not most of you, say some of you take that alert right then and there. So you get approximately the same cost basis that I get. Some of you get in later or just wait, and the price or the trade starts going against us a little bit and gives us a better position to get in, at lesser cost. And so some of you will get in there. And I see it all the time. People say, hey, I got in here for 25 cents less than they're earning. Nah, 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 right? So you did better. But if you got into that original position, right, and you have another tranche to go, and now the cost of entry is 50% less, well, you could put that second position on because you can afford to put it on because your account size allows 2 tranches, say. And now your average position size is 25% less. So that's when you would add. Now, I'm giving you arbitrary numbers here. I'm saying that add your second position size when the cost of entry or the total risk is 50% less. You can choose whatever number you want. You can say 25% less, 33%, 50, 75, whatever you want. That you won't add another position unless it gets to that. You may not even add another position like that. Let's say we had a complete reversal in the market and it basically blew away our trade. Why would you add another position if you thought now the trade is totally a loser? And so why would you add another position? You probably wouldn't. You probably just say, well, that was my risk. I put on that first position. I'm good with that. We take small risk for the potential for very large gains. We're good. Now maybe there's another trade that we're looking at later in the day, or maybe the whole scenario changed. Now I have to look at that, right? So that's how you look at position sizing. Always start small. Add if you can improve your position. Now there are some cases where you may even add if you can't improve it because the trade is just so darn good and we have this positive vibe. Everything's working in our favor and everything points to it moving towards the tent. And the position is, and you have another tranche to add and it still stays underneath your max position size, then you can add it in there. But ideally you would like to add it in order to improve your position. Here, you could add it if adding or creating a bigger size position makes sense to your size, and the likelihood is that we're going to start moving into profit. So you want to push more chips into the table, and so you can because you're still under your max position size, or you're within the limits of your max position size. Ultimately, you would prefer to get a better price. But if you can't get a better price and the trade looks like it's going to be better overall, then you could add another one. Do you see the difference? This is me pausing, waiting for you to respond with, yes, Ernie, I see the difference. That all makes perfect sense. It's just beautiful how you just laid all that out, and it's completely understandable. I understand. You never have to say another word about it ever again. Fat chance. Of course, I'll say more about it, but I'll keep on drilling it into you. Does it make sense? Does that type of... Now, your schedule of adding positions is completely your own. I can only give you suggestions. Thanks. I can only give you suggestions, right? What I say, you may take as gospel if you'd like. And I'm very flattered that you might take my word as gospel, but I'm not no God, right? I'm just a guy here that has some experience that's telling you what works in my estimation, in my 40 years of doing this. Generally, you want to trade small. You want to keep it as small as you can. But if you can add to it and stay under your max risk and get a better position, that's great. You want to trade with it's always better to trade with a larger amount because then you have more flexibility. When you have, say, $10,000 or $15,000, you have way more flexibility than you do when you have $5,000. Because first of all, with the $5,000, you're never going to do more than one tranche. With $10,000, you could go 2 tranches. With $25,000, you might be able to go 3 tranches. Now imagine the flexibility you have there. You get in, you have 3 tranches. We get up to about, let's say that we're at a point where we're in profit. We're not even in the profit tent, and already we're at 100% profit. You say, well, I have 3 tranches. I have 3 tranches. If I take 2 of them off right now, I guarantee 100% return on my money. Or something like that, right? You get 2 tranches, you've locked in that profit. The worst that can happen is that 3rd tranche can go to max loss, but you still have 2. Right? You guaranteed yourself a profit. The reason why you would do that is that you want to lock in those profits. You lock it in, and then you have another tranche still going for the possibility of gaining more, or more profit, more realized profit. Everything's unrealized until you actually take it off. Now that one extra tranche, if it moved and pinned the trade, that one strike or that one tranche might make more than the other 2 combined by orders, maybe 2 or 3 times. But the risk that you're taking is super small. There is no risk that you're taking. So that's the flexibility you have when you have more tranches. Hopefully that all makes sense now. So ultimately, you want to build your account to get up to that point where you can get to multiple tranches. But I wouldn't get too giddy with this. Don't get too aggressive. As a general rule, like I said, one tranche up to, say, $7,500, between $7,500 and $15,000, 2 tranches, from $15,000 to, say, $25,000 or $30,000, 3 tranches, up to $50,000, maybe 4, say 50 to 100, 4 tranches, 100 to 250, maybe you can go anywhere from 5 to 10 tranches. All right? Now, of course, if you had a $250,000 account and you allowed yourself up to 10 tranches, then you probably want to put on 3 tranches, 4 tranches, maybe even 5 tranches as your initial position. And then you can take, the other 10 that are left, or the other 5 that are left, and then figure out how you're going to divvy those up. But you have much more flexibility now. Don't try to put all your chips in at once unless the position looks really good. It looks like we're going to have a very good chance of profiting or realizing a good profit. And take off positions, lock in profits, realize gains when you can. Ultimately, you want to realize enough so that whatever you leave on guarantees you a profit even above expenses. So you never have, you always have to put the expenses into the equation, right? Figure out what your expenses are, how many extra points that you need to get to cover those expenses and create a profit. So those are the general rules. Now, what you should do then is you should maybe work this out on a spreadsheet or something. And it's not hard to do, right? You just look at what your total position size is, what your max risk that you want to take. Use that guideline that I just used, that 5% for accounts up to $5,000 is probably good. Say 4% up to $15,000, 3% up to $25,000, 2% up to $50 to $100, 1% up to $250. That sounds about right to me. The whole idea behind that and keeping each individual trade down below a certain amount is to guard against periods like we had in January, worst period I've ever traded in my life, where you might not have, or you may have, say, 5 out of 6 trades that are losers. That can happen. It could get even worse in some cases. It's maybe hard to imagine that you could lose, say, 10 in a row, but you could. What would you do if you lost 10 in a row? Can you sustain 50% loss in a small account if all your max losses were 5%? For the small account, you probably can, right? Because if it's a $3,000 account, you go down to $1,500. In the grand scheme of things, you could probably just save up for a couple of months and add another $1,500. On a $50,000 account, losing $25,000, that would be a completely different story. That's why you wouldn't do 5%, right? You would do maybe 2%. Right? You don't want to lose 50% of a $50,000 account because, that's ridiculous. That's why you trade smaller as you get bigger. And then your equity curve will become smoother. It won't have the same volatility. It'll have volatility like this instead of like this. Now, hopefully everybody gets what I'm saying. This is fairly elementary stuff, but it's the thing where most traders completely fail at. And what I just talked about, this relatively simple concept, staying small and only committing when you think you've got an advantage, and make sure that you stay small. No matter how good it gets. Because there are times, I'll tell you, where it got so good last year that people were just pushing in all their chips. And they were lucky that we didn't have a January like this past January. We just had smooth sailing. And it was wonderful. But what they were doing is they were reinforcing a terrible habit. And so when it gets time to where you have a tough time, breaking yourself of that habit becomes very difficult. So you have to become disciplined in how you actually do this. Paul says, trading too big was my kryptonite. Thanks for clarifying the percent rules to limit risk. Right. The other thing that we try to do to limit risk, obviously, is by trading asymmetrically. Trading small risk for very large potential profit. That's one of the main things, the main nuggets of this strategy. Asymmetric risk to reward. So if you have asymmetric risk to reward, don't ruin it by doing stupid entry sizes that are way beyond what you should. Don't figure, well, I'm really not risking that much for this potential reward, so I'm going to push more chips in. See, if you were trading the other way, the way most people are trading, where they're trading huge risk for small rewards, they're constantly worried about their risk. They spend all of their time and all of their anxiety and mental effort on trying to limit their losses because they can't afford any kind of screw up. Here, we can afford big screw ups and still come out smelling like a rose. But if you push too much in, those advantages go away. All right. So now you know why we trade asymmetrically. On Friday, we had a nice trade that worked out well. I introduced a new strategy called the ratio backspread. In this case, it was a put ratio backspread. And the reason for it was it is also an asymmetric trade, first of all. And so I'm going to illustrate what it is. Let me just say what it is, first of all. A ratio back spread is a spread, but the ratio of long and shorts is different, right? It's not 1-to-1 as it is with most spreads, right? You go long 1 and short 1. Here you go long 2 and short 1, or maybe long 3 and short 1, or even long 3 and short 2, right? The shorts are always less than the longs, and then the shorts are always closer to you than the longs, or closer to the actual price. So let's start with that, and let's move to a new window. All right, here we go. So I'm going to draw the risk graph, and I'll illustrate what a strategy like this will look like. And this is going to be the put ratio back spread. All right. Let me use this. I'm going to say that right here is at the money. That's the current price. And so what we're going to do is we're going to find a short strike that's close to us. This is -1. And then a long strike that's a little further away from us. +2. And then that will create, if this short strike is close enough to us, that will create an actual credit. But the risk graph at expiration will look like this. All right. This short strike would be right there, right there. All right. So you'll have a little credit right here. There will be potential loss right there. And your gain will be here and then here. As you can see, you'll have potentially unlimited gain. When you first put this trade on, the profit curve will look something like this. So that's your P&L. In real time. The cyan line is your P&L at expiration. Now, why would you put on a trade like this? So we'll probably put on a trade like this prior to, say, an earnings report or a big economic report or a Fed meeting or something like that. Well, a Fed meeting would be probably too late in the day, because we really want this P&L to look like this, so that when we put it on, you know, we're we have really no risk. It could even come down like this. All right. So when we put it on, there's no risk. So that if price, I'll use a different color for price. Let's use yellow for price. So let's say that we put it on in the morning, and then price immediately drops like this. We would be looking to take this off very, very quickly, right? Depending on how fast price is moving. So let's say price is really cooking. Market opens or a report comes out and price drops 20 points. This trade, if it's a 1 to 2, 1 short, 2 long, is probably going to make us a couple $100 almost right out of the bat. Right? Well, Hans, there is risk. The risk is that you hold on to it. Now, I'm going to get to that. So let's say price moves down, right? As price moves down, it's going to be following the P&L like this in that first hour or two of the market. That line, that P&L line, over the course of the day is going to start shrinking. So at past noon, it might look like this. And then at near expiration, it might look like that. So if you remain over here, like a dummy, if you remain over here, well, let's use red for that, right? That's a dummy move. If you remain over here throughout the day after it moves down and fail to take that initial profit, then you are going to experience an unrealized loss. And you're going to be hoping that price goes in this direction. So that you can get out of it, or continues further down so that you can get out of that unrealized loss. That's why you don't hold on to it. This is well, it's why you don't hold on to it if it goes in towards the long option direction. If it goes towards your long option direction, let's say that it's a monumental report. It was so horrifically bad that the chances are that it's going to keep on going. Then that might be a case that you hold. But let's just say it's bad. Sometimes bad ends up being bad initially, and then the market turns around and says, well, it wasn't so bad, and then the market goes in the other direction. Or they say, well, it was pretty bad and we're good right here, and it just stalls in this area. If that happens, you have 10, 15, 20 minutes to make a decision, but by all accounts, I would be getting out of that position and taking my $200, $300 that I made on that move. If price moves to the right and goes this way on that, I'm going to hold as well, because now the chances are that it's going, depending on how far it moves, it's going to receive this credit right here, which should be green, right? It's going to receive this credit right here. Now, if it's really bad, it could potentially receive this credit way out here. But, we're not really banking on that. All we really care about this way out there is that it is the thing that gives the strength to this curve here. Right? And we're looking for that initial move. So if it moves to the downside, then we'll take that quick profit and we'll be happy. After we've taken the quick profit, we can then maybe look at a butterfly and then use maybe some of that profit to finance the butterfly. Maybe we can take a more aggressive butterfly. If it moves in the opposite direction, let's say price moves this way, and it's a strong move, like it was on Friday. It moved way up here, way up here. We didn't have to do anything. Just sit there. And then what we did was we then added a butterfly out here. This is exactly what happened on Friday. And price ended up inside the butterfly. Right at expiration, it was like very, very much inside that butterfly for most of the day, from like 11 o'clock all the way until 2:30, I think. Then it started to move. It went whoop, up, it went up here, and then I don't know what happened there. Lost it. Price ended up almost exactly. Why does that keep on doing it? Oh, because I didn't choose it. Price ended up almost exactly right in the center of the butterfly for most of the day. And then at the end of the day, it went whoop, and then like this. However, so you would have lost on the butterfly, but you would have gained on the credit that was on the ratio back spread. All right. Sam's asking, can we use the ratio back spread all the time as insurance for any butterfly we use? It's kind of a judgment call. I don't want to complicate things and say that this is now the strategy that we use all the time. I'd rather use it in cases where we expect a sharp move, one way or the other. Right? It's going to be an explosive move. Maybe the volatility is high. It's going to either go way down or way up, and we can take quick profits on the way up, or we can collect the credit if it goes the opposite direction, and we can use that credit to finance a butterfly. So I don't look at it. I don't want to ever look at trades as insurance for our future trade. And that was a mistake that I think I went down when we started talking about broken wing butterflies, and started looking at insurance trades and all this other crap. Let's just forget about insurance. We're here to make money, not to be, cowards and just step forth when we have a perfect platform for us to step on. That's just not reason. It's not realistic. Let's just put these trades on and try to capture the move, grab it, and if we don't get it, then we take second best. Second best might be the small credit that we got. Les asks, what would be the case for a butterfly within the two prices at the blue line crosses, hoping to negate the drop in the blue line other than cost? Well, the only time we're going to put a butterfly on, look, if it goes left, right, and then it rides up the P&L, the purple P&L line, we're going to take profit, then we're going to be out of the trade, right? Period. We're going to that's it. Its use is done. We extracted a nice little profit out of it, and we're all happy, and then now we're looking to put a butterfly on somewhere. We're not looking to hold on to this trade if it goes towards that risky portion. If it goes towards the risky portion, we want to take profit quick and get out. If it goes the other way to the small credit side, the long tail credit side, then we can hang out with it for a little while. No harm. Or we could get out of it at any time. Still, no harm because the cost is going to be so little. But, if it goes far enough to the right like it did on Friday, we could just sit in it for as long as we want because we know that there was a $1.20 of credit there, and there was really very little chance that it was going to move to the left again because market had already ground up and kept on grinding up. So we stayed in it. And we added a butterfly on top of that. Lance is saying, why not use bookend back spreads early in the morning? Well, that's just guessing. You know, we're already guessing. Why just pile on the guesses? That doesn't make any sense either. And that kind of goes to the question, well, why not put on poor man's straddle or strangle all the time with two butterflies in either end? Then, we can't lose unless we stay right in the middle of the two. And then we put out all of these contracts and all of this cost, and we realize that we need a really big move, and we need it to end up in one of the butterflies in order to just get over the costs. Again, not a great move. Again, that's trading scared. Let's trade confidently. Trade minimally, as minimal as possible. And the thing I like about the back ratio spread, it only uses 3 contracts. And it'll either make us a lot of money or make us a little bit of money. Those are the only 2 scenarios that we will allow. The other scenario of hanging out over that where those long strikes are, where the long strikes are actually at right there, is unacceptable. We don't, if price stops there and we don't take profit, then that's on you. That's your stupidity for not getting out. If you think that you're going to hold on in case it will keep on rising or go back here if it starts dipping, again, that's not the trade. The trade is to take the profit quick and get out. That's the trade. If from at the money right here, it decides to go this way, there's really nothing to do. You just hold on to it because you're going to most likely collect that credit. Jason's asking, are you essentially putting the spreads in a volume well so that it would likely move through the negative tent? That's a very astute observation. And I didn't even talk about placement of these trades and why I might put one on, and that is a very good reason. If this I'm going to redraw this. I'm going to go back and let's do this over, and all right, this is at the money, and let's say that there's a node here. This is a volume node, and there's a well here, and then there's another node way out here, right? And we think that price is going to violate the edge of this node, and so then we decide to put on one of these suckers like that, because we know that if price violates this edge here, that price is likely, if it goes beyond, say, that edge, if it breaks through, then price is likely to go this way. And if it does, then we're going to be there to capture that profit as it does, as it moves into that well. Jason, is that what you were asking? I think there's a delay on this, so I'm waiting to see your response. There might be like a 10, 20-second delay or something like that. But yeah, that's exactly the situation. That we might place one of these ratio back spreads in such a way that there's a very high likelihood, if price starts to go down and breaks through the edge of a volume node, And let's see, we'll use like this dark blue thingy for the edge of a volume node. Let's say that, you know how I draw my boxes? My box on the chart might look like this. And then this is the edge of the node, and price, if it goes there and into the well, it's likely to scoot right into that well. That's exactly right. That's exactly right. Where on this case, if it goes in the other direction and breaks through here, and then there's another node here, like there was on Friday, it came up and joined with that node. Right? So price went from, it started here, and there was a little bit of volatility in the morning, right? It went like this, and then it went up, and then it went all the way to here, and it consolidated, and then at the end of the day, it did something like this. So we caught the credit that we had here. It never got into this side to experience this, to get beyond this, and never rode up this profit line. So that part of the trade was gone, but the consolation prize was the bringing into the credit. And then what happened was when it moved to the right here, we decided to then put on a butterfly right here, like that, just like that. That's what we did. That was the Friday trade in a nutshell. So the first idea was put on that put ratio backspread to potentially capture a sharp downward move because of the employment report. Because everyone was looking at the employment report because they saw the ADP report the Wednesday before, and it was horrendous. It was unbelievably bad. So everybody thought, well, ADP report, actual time slips are showing that job creation was a big failure. Right? So who was to expect that the government numbers would come out 2 days later showing that, oh no, ignore all that real information directly from ADP, who is actually tracking real information, and use our numbers that show we have an unbelievably huge expansion of job creation after just 2 days. Hopefully you note my sarcasm. I do not believe, and I believe the market did not believe it either, did not believe the government jobs report. It was total fabrication. It was the most egregious piece of bullshit I've ever seen in my life. There's no way you can go from one extreme to the other using real data versus government-produced data and then tell me that we actually created 400,000 jobs when ADP said we lost 300,000 jobs. Jason saying, would be wise to take the profit if it gets to the lowest point of the well, where you draw a line of the possible reversal. Yeah, that's also another very good point. So what he's saying is that if price were to move down, from at the money, we start right here, and price were to move down this way, The low point of this well is usually an inflection point. However, if it got through there, you might want to hold on to it. Right? So, but if it got to the low point of the well, the low point, it might consolidate a little bit. If it started consolidating a little bit, I'd probably just say, hey, I'm happy. Take my money and run. But if it moved right through it, I would hold on because, there's the potential for making a lot of money. But that is a point where, yeah, you would definitely want to watch that low point of the well. Yeah, Les, I just, when I saw the government numbers, immediately I said scam, total scam. Actually, in the room, I said, this is going to produce market, everyone was going to try to evaluate this and try to figure this out. And that's why we had confusion at the beginning of that market. And then they just decided, well, let's just go up. Yeah. So these markets are 100% manipulated by the government, by the Fed, and if institutions can do it, they're going to manipulate it too. It kind of all evens out, right? All we really care about is where price goes. Yeah, they'll probably revise it next month, I'm sure. Or they might not. They might revise it up. It all depends on whether or not it fits their narrative at that time. And this is really a sad, sad time in American history that our government manipulates the numbers this much. It's really unbelievable. When you see direct, real evidence in front of you, and then you see the opposite result, not only just the opposite, but so unbelievably opposite and outside the norm that it is a statistical improbability. It's sad. So, but you can't sit there and complain about it. You can say, well, there they go again. They're playing to the media or whatever. We don't care. All I care about is it going to add enough energy in the market for price to go one way or the other? So there you go. Are there any questions? We're about an hour in. I think we've covered a lot. First of all, we covered position sizing. We covered how to add new positions, when to add, some guidelines on risk management in terms of your position size and the size of your account. Then we talked about or reviewed our trades last week and a new strategy that we're introducing. And it's not something we're using as insurance or anything like that. It is situational. If it makes sense, strong economic report at the edge of a volume node into a well, possibly make a lot of money very quickly. If not, if it goes the other way, take the consolation prize. Right? It's an asymmetric trade because it has limited risk, and that risk really is determined in two ways. One is obviously it's limited. The max risk could be relatively large compared to the infinite upside. But on the other side, the credit is, that's kind of limiting too, So it's a good trade. It's just that you use it where you want to use it, where it makes sense. If it gives you profit quick, take it. If it goes the other way, take the consolation prize. Sam's asking, do you think we are finally out of the dreaded volatility crush based on the behavior of the market from your most recent trades? Yeah, things seem to be working now. We had 2 out of 3 winners this week. We had one winner last week. I'm feeling more confident now. I mean, and it seems that we're not getting as sharper price reversals. I think the market itself is a little bit more confident in the moves. I think that the Friday move just totally blew everybody away. But once they decided that they're going to go one direction, I think the market has settled on and digested the fact that the Fed is going to raise rates probably 2 or 3 times this coming year. And even if they don't, they've settled on it, and then that's how they're going to act because the Fed said so. And that's pretty much the way the market is. If the Fed said it, that's how we're going to act. If they don't tell us and then they keep us guessing, then that's what happens in that liquidity trap that we were in the beginning of the year. They had no idea what the Fed was going to do because the Fed is sending mixed signals, and by all accounts, it appears that they don't know what they're doing. Let's see. Lance says, like the idea of targeting movement through the wells supplements targeting the nodes via flies. Yes, absolutely. All right. Any other questions? If there are no other questions, then we will adjourn and say thank you very much. Market opens at 6 o'clock this evening. I will be looking at it and send out a new market structural report. Let's see. Do you have criteria when we can expect the ratio backspread? Expect a ratio backspread. Well, we just talked about, when to expect it. If we think that there's an economic report or some energy in the market, or even overnight action, and we're on the edge of a well, then we'll put it on. So we'll probably put it on more often than you think, but it's not going to be like every day, every time. But if we can capture a strong move one way or the other, and the market structure is such that it gives us a good opportunity to do that, then we'll do it. If it doesn't work, then we take the trade off. The worst that's going to happen is that we're going to risk a few dollars in the cost of the trade and maybe lose a few dollars one way or the, maybe $10 or $15 one way or the other. The best that's going to happen, there are two bests. One is really good, one is pretty good. The best that's going to happen is that the trade works and it moves towards the long strikes very rapidly, and we make a quick $200, $300, $400, $500, or even more if it keeps on going. There's the potential for making thousands of dollars if we had a complete breakdown. Or it goes the other way and we collect the credit. Right? So the criteria, again, is going to be a discretionary one, but I gave you the setup. The setup is strong energy coming into the open of the market, and we're sitting there on the edge of a well, and it looks like the potential, if we entered that well, if that energy that is entering the market added to that and broke through the support that's provided by the bottom of that volume node into the well, then we'll put on credit spread just in case that happens. I'm sorry, a put or a call ratio backspread. And either we're going to be in it for a very short period of time, or we're going to ride it out if it goes our way for the consolation prize. So there's the criteria. If you're looking for like hard and fast numbers, I don't know how you do that. There's no such thing as hard and fast numbers. I just gave you the setup. Strong energy, edge of well, breaks through the well, take the trade, take the profit and run. If it goes the other way and we get the consolation prize, then we also look to add a butterfly to see where, excuse me, where price might end up, and try to capture the rest of it, just like what we did on Friday. All right. Hopefully that was helpful, clear, understand it. I'm going to add more about the back ratio spread, and I'll put it in the option resource center, the zero DTE strategy part of the Discord. I already have a few slides up there that kind of explain it. I'm going to put some more slides in there that will, and then I will add it to the course, and then we'll just talk about it. We'll be doing it. We'll look at potential setups for it, almost every day. Doesn't mean that we're going to do it every day. We might do it once a week, once every couple of weeks, maybe 3 times in a week. Who knows? But it will be another tool because I think it's a simple tool. It's very flexible. You can actually turn one of these things into a credit spread, by the way. We can also fool around with different ratios. We can do 2-to-1, 3-to-1, 3-to-2, and then go from there. All right. I think we're done here. Thank you very much. And I hope you all have a great rest of your Sunday. And we'll... Oh, by the way, if I want to mention one more thing. One more thing. So I've been putting a lot of work into this idea of capturing and holding on to your wealth. And I've suggested that investing in Morgan silver dollars is a great way to go. And I have a huge, huge reason why I think that it is as good or better than stacking gold and silver. Although I think stacking gold and silver are good too, but the prospects and the overall growth or the appreciation of these rare coins, particularly Morgans, and their limited supply is a fantastic way to save your wealth. I think it is actually better than saving gold or silver. And it's a lot of fun. And there's infinite variety. There's so many different ways that you can do it. You can do typesets. You can do varieties. You can do VAM varieties. You can do certain mint marks. There's like maybe 150 different ways that you can trade or invest in Morgans. And the whole idea of getting going to auction and getting great prices. I can show you how to get great prices. I have a deal with dealers where I can get things at wholesale prices and then pass them on to you at minimal cost under retail. So you would automatically be getting these coins at a better price than anybody else can get. So think about that. And I'm going to continue building up my site. The site that I've built is called, let's see, it's called uscoincollector.org. I will also have a Discord channel that will talk about that, and including the strategies and other things. But there will be a course that I'll create on the website, and you'll have access to that if you choose to join that. And I think, I've been, let me just show you some things here. Now, I only invest in the highest quality graded coins. All right. So here's an 1886 Mint State 65 Morgan. That green sticker that is on it is actually very important. That's a secondary grading organization called CAC, and that actually improves the value. The grading organization that I use is PCGS. That actually adds premium to these coins. All right, so this is this is an 1886. All right, that's a Mint State 65. Let's see, what is this one? This is a also an. Let's see, this one is a 1887, Mint State 65, but you'll notice that it has toning on it. That toning is something that's desirable to a lot of collectors. So there's another avenue that you can go down. Is there any possibility of using Morgan dollars as income play instead of wealth accumulation? Can they be traded? Yes, absolutely. Monthly, probably. Daily, probably not. But you can obtain these through me at great prices and then put them on eBay and probably, get a profit on them, 10, 15%. So there's an arbitrage opportunity there. Also, you might hold on to them for a year and then trade them in for if that particular coin jumped in price for whatever reason, and get a return that way. But there's a lot more room for that sort of thing in the higher quality grade coins, right? But you can also go to the low end. You could oh, what happened to my camera? Huh. That was weird. Cam link. That was weird that it turned off. But anyways, here's one. Here's a very interesting coin. This one is a what's called a deep mirror proof-like. If you look at it, you can see it almost looks like a cameo. Right? Here's one, a higher grade. This one is MS66. Carson City. Notice it says 1883 CC, Carson City Mint. Carson City Mints have a particularly higher premium than most other coins. Here's one that's almost a perfect coin. It's a MS67. Right? It's a gold shield by PCGS. So there's endless varieties that you can invest in. And if you learn about them, you can actually make a lot of money. And it's a great way to store your wealth for a couple of reasons. One is they have appreciative value. You can have an arbitrage where you can trade them and make money on it. Also, they are very liquid. You can go anywhere and you could sell these on eBay in an instant. You could put them on. You can go to your coin dealer and he'll buy them from you. You can put it on auction and send it to auction and possibly make a lot more. But the cool part about it is, although it does take a little bit to go through that, if you need the money right away, it might take you a few weeks to a month to get the money out of it. But that's good, because if it's something that you're storing for your wealth, then that's what you want. You want something that's not easily transferable to cash. It's the same way if you buy bullion. You have to take the bullion and then go to a dealer and then turn it in or send it into APMEX or whatever, who will rape you. But these are a lot more fun. There's never a problem with actually getting rid of them. The market is always there. It's a huge market. And mostly people who are well-heeled are in this market, and they're willing to pay the money. And often you can get exorbitant premiums on top of what you paid. Yeah, I'm frozen? Okay. All right. I don't know why. That's weird. But anyways, let's end it there. And I will give you more information about that. I'm going to start creating an inventory. If you're interested in it, then I'll start doing some live classes on it. And I'll also put courseware up there and get some people to, if you want to sign up, if you're interested in transferring your wealth, or not transferring, but storing your wealth, and also looking at it as a money-making proposition. It's not as strong of a money-making proposition. You're really looking for appreciative value in the same way that you would look if you were storing gold. If you put cash in the market, cash in your account, you know for a fact that cash is going to inflate away. So you put it into stocks, you put it into real estate, you put it into antiquities, rare coins, precious metals. Of all of those, I believe that rare coins are the strongest of those hard assets other than income producing property. All right. Sorry I'm frozen. I don't know why, but must be a YouTube thing. We'll see you next time. We'll see you online. Thank you very much for coming. And peace. Peace to you all.